and thank you for joining us. I'm Fiona Cincotta here at StoneX TV, and with me I have the pleasure of talking to Josh Cannington, Vice President of Interest Rate Risk at StoneX. Thank you for joining us here today, Josh. So let's just kick off. I mean, you've obviously had a very busy few weeks. Tell me what you're seeing as far as interest rates are concerned, or expectations for interest rates.
Yeah, I think interest rates are really interesting. It's almost like a tale of two stories right now. The Fed is doing one thing, the market is just doing its own thing. So inflation is slowly but surely grinding to 2%, which is their intended target. It's not making huge, steps lower and improvements, but slowly but surely it is. It's kind of boiled down to shelter inflation at this point. Spot floating rates, they're getting cheaper, but longer term fixed rates are getting more expensive. And it's just such a interesting dynamic where you have the two kind of competing against each other. And the primary driver is Trump and what kind of policies he's proposing, and what kind of inflation implications each of those policies have. So you have the Fed looking at inflation today and employment numbers today, right? But the marketplace is a forward-looking place, and they look at Trump's policies and speculate that inflation will only move higher from here, and the Fed eventually will have to pivot. The Fed is not ready to speculate just yet. They want to see the policies. They want to be able to model out those policies, and we just don't have those details yet. The marketplace just doesn't believe them, and they're pushing longer term rates higher.
Yeah. See, that's what's been playing out. What is, as far as Trump's policies and potential impact, then what do you see as the main risk?
Tariffs are the primary risk, and maybe even immigration too, to some degree. But tariffs are feared that as soon as tariffs are put on to imports coming into the U.S., it's going to be a one-for-one pass-through to the consumer. I find myself a bit skeptical that it'll be a direct pass-through, and I find myself more on the contrarian side of things, that I'm not so sure how inflationary those tariffs will actually end up being. But again, we know that Trump is a wild card in a sense, and that things can change in a minute. We could get a tweet tomorrow, and the whole story and the narrative could change. So it's tough to kind of forecast or look into the future and model out the what ifs. But today inflation is lower. Yes. Unemployment in the labor market is weakening. Those things we know. And again, it's until we see policy in place, and laws being passed and tariffs being put on, can we actually make an educated guess on what's going to happen next? In the background of all this, there's some soap opera between Trump and Powell.
Yeah.
It doesn't seem like Powell really wants to bend the knee just yet.
Like, completely. So true. The dynamic there is so interesting.
It is.
To be watching how that plays out over the coming few years. And then, so I guess the other thing to keep in mind as well is sort of how the US interest rates and expectations surrounding interest rates compare globally. I mean, what are we seeing? Are there trends that we're seeing forming between other sort of interest rate expectations, or is the US now out on its own because of this potential sort of different direction with Trump?
There's a loose connection between central banks globally, given the currency implications. If one economy is cutting rates and the other one's holding them, there's some currency and FX implications there. So generally speaking, most central banks move in unison. At least over the last, say, 5 to 10 years, that's been the case. There's some economies that are weaker. Maybe they cut more or more aggressively. But again, I think if trade wars truly bubble to the surface as a tension, that's a game changer. We may see rate cuts stop altogether. And I think the upside for, say, floating benchmark rates are more of being held steady versus hikes being reintroduced. Because again, the gap between, say, like inflation in the US and the federal funds rate is like 250 basis points. There's still plenty of cushion for Powell to maybe absorb 3% CPI, 3.5%, before, the word hike gets introduced to Fed meetings. So like the hawkish stance maybe would be like rate cuts, stopping. Maybe the less dovish is to space out those cuts, but the base case still is try to get to 3%, and get to neutral without, again, the job market breaking down any further.
Yeah, completely. And it's interesting that you point out that sort of that level of neutral has been lifted, perhaps from where it was previously. Talk us through why that's been the case. Why do you think that's happened?
Neutral rates is a you'll know it when you see it type of mentality. It's the same thing with the Fed's balance sheet. Is that they'll stop unwinding the balance sheet when the level of reserves feels appropriate. You'll know it when you see it. So it's really hard to really understand what neutral is. And you'll know if you look at the dot plot, that long-term median, that's a huge range. So even internally, the smartest people in the room and the economists at the Federal Reserve, they don't even know where neutral is. So it's one of those things that you can kind of formulate in your head, but you really won't know it until you see it.
Yeah. That sounds reasonable. It sounds extremely reasonable. We sort of always had that focus on that sort of 2% level, but it feels that it's just shifted, and that's not sort of appropriate at the moment anymore.
The deficit is probably the second wild card. That is a generational problem that's not going to go away anytime soon. And as long as governments are spending more than what they're bringing in, and that deficit widens, they're going to keep borrowing in a higher rate environment, which is going to cause them to borrow more. And it's a tough cycle to break. It really is. And, you could maybe say like in the short term, 25, 26, you kind of formulate where the 10-year might go if tariffs are implemented, where rate cuts might be. But 20 years from now, that deficit is going to naturally push the 10-year and longer term rates higher.
So just as far as the risks then we've talked about Trump, we've talked about trade, potential trade wars, we've talked about US deficit. Is there any other sort of major risk that's out there that you're sort of keeping an eye on, or is that sort of sum it up as the risks?
At the front of my mind is tariffs, because they're so front and center to the risk outlook. I would say that's probably risk number one. Because inflation has a lot of momentum behind it. The last kind of stickiest part of that is shelter, and it's kind of counterintuitive, but higher rates are keeping shelter costs higher too. So it's it's a really rate insensitive. We've tackled the easy inflation. Now it's the hard stuff that's kind of immune to the rate world. So expanding on the risk, it's hard to see past tariffs at the moment.
Yeah, completely. And I mean, I remember from when Trump was in his 2016 to 2020, I mean, that was the busiest 4 years that we had. Just as you said, like one tweet and everything can go.
Right. And I always look back, it's like, well, it sounds like Trump wants to have a heavy hand in rate setting policy as well. And that is a major risk too. Powell's term ends in 26. So he's going to be able to nominate a new Fed president, a new Fed chair. So and we know Trump is a real estate guy. He likes cheap rates, right? So if that happens, I guess the worst case scenario on the rate front is that tariffs get implemented. That's inflationary, and then Trump cuts rates to zero. That's kind of the worst case scenario, where that's going to cause a lot more problems than solve anything else.
Yeah, completely. And it's not completely to be unexpected. I mean, with Trump, it's almost expect the unexpected. So that could be a possibility, I suppose.
It'll be an interesting next year, that's for sure.
I feel like we've covered lots. You've highlighted a lot for us. You've laid out the risks ahead. Is there anything you feel we've missed? Or have we covered everything? Is there anything else that you feel that we should have touched on?
We could probably get granular and talk about,
nuances with credit risk and where bond spreads are trading. But I enjoyed our conversation, and thanks for having me.
That's brilliant. Thanks so much for joining us. It's been an absolute pleasure. Thank you.